Howdy, Jacob here. Today we're looking at Zoetis in the pharmaceuticals industry. 75 billion market cap and 79 billion enterprise value. I still always chuckle when there's companies that I've just never heard of that are extremely highly valued. So it looks like they discover, develop, manufacture, and commercialize animal health medicines, vaccines, and diagnostic products. Makes sense that it's crazy high market cap. People love their animals and such. 1952 founded. Growth is not crazy sexy, less than doubling over the last 10 years, but we are seeing pretty consistent growth, which is a very big positive. And a lot more positives. Return on invested capital is growing from 12% to 19%, operating margin from 20% to 36%, and gross margin from 64% to 70%. So those are all very good, very positive things for this company. Their dividend is growing quite a bit, earnings per share growing quite a bit. Very good positives there. Balance sheet has 2 billion cash on hand, 3 million short-term debt, 6.6 billion long-term debt. Hasn't really increased or decreased over the last 5 years, 6 years or so. That 6.5 billion in relation to free cash flow is appearing to be just over 3 years of their 5 year free cash flow. So I wouldn't say there's really much concern with that balance sheet. Their use of cash is a little bit of acquisition and quite a bit of share repurchases, using about 50 to 60% of their free cash flow to repurchase shares. Their dividend is paying out 30, 30 to 40%. So that doesn't leave a whole lot of money to reinvest or make some acquisitions. But we do see the company has increased capital expenditures a bit, so they are reinvesting in uh, products or property to hopefully make future growth and such. Um, so I think I'm ready to make some assumptions here. Let's go on the revenue side, maybe 6%, 6% a year. So what is the growth they had in the past? 544 over 4.785, and then that was over, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9 and we are looking at a growth rate of 6.6%, 6.7%. I think 6% for the next 7 years, or 6% a year for the next 7 years. Seems pretty reasonable to me. I know they're already a big company, but due to the fact that they can reinvest, make acquisitions, I don't think that that's really a concern for the. I don't think that growth rate is a concern. Margins all look good. 26, 22 share change. What would 1% be? $747 million in aggregate. Yeah, with their, so about 800 million with stock-based compensation. I'm pretty comfortable with that. Terminal PE, good growth, huge company. They probably have a moat in their industry. It looks like all the moats, the quote unquote moat signs of increased margins. Um, earnings growing greater than revenue is always a positive. So I think 18 PE, price free cash flow, makes sense to me. Dividend is paying out pretty small, so let's grow that. Let's grow that a little bit more than the revenue growth. Payout for that staying in the 30 to 40% range, I'm good with. Buying back shares with about 50%, leaving 20 to 25% to buy back, or to reinvest back into yourself or make acquisitions. So good with all that, and it just looks a little bit expensive at this price. So I'm just waiting for it to fall more, and I hope you enjoy the video and have a great rest of your day. We'll be coming out with more fundamental stocks. This is the end of what I've initially done, but I'm going to this is when I ran the screener about 2 months ago or so, so I'll have to rerun it, add a couple companies that are new to it, and then we'll be going to the next screener. So hopefully you enjoy the video and have a great rest of your day. Thank you.